Federal Reserve is expected to cut interest rates here. And before we jump into that and some things that are happening in the interest rate environment, I think it's important for us to talk through why interest rates matter to entrepreneurs. And there's a few things that I put together, but I'm curious to hear your thoughts. The first thing that comes to the top of my mind is borrowing costs. So whether it's mortgages, home equity lines of credit, security-backed line of credit, any type of borrowing that we as consumers or entrepreneurs are doing, that's going to be dictated by the interest rate environment. Second thing is valuation in stocks and in real estate. And then also the thing that is really true, that we've seen a slowdown in the M&A market, because a lot of people don't think about this, but a lot of these mergers, acquisitions, sales to private equity companies, they're generally financed about 50% with debt, 50% with equity. And so that means private equity companies are borrowing money to then go buy middle market business owners like our clients out all the time. So if their borrowing costs are going up, it's just more expensive for them to buy companies. So if rates go down, maybe the M&A market loosens up a little bit. So as of today, middle of September here, we have a 92% probability of a 25 basis points cut. And in layman's terms, that's 0.25%. And this is from the Fed Reserve here in their overnight rates, and a 8% chance that they're going to cut interest rates by 0.5%. So that's what we're looking at now. And then as we have a second chart here that just shows a historical federal funds target rate over the last 25 years. So it looks a little bit like some hills, that it was up above 6% in the early 2000s, came down after the dot-com bubble bust, was raised up into about 5.25. That was when the great financial crisis came. Interest rates went down practically to zero. The Fed was starting to build those back up. Boom, COVID hits, you see another waterfall down, and then you can see a huge and rapid spike in interest rates from 0% up to that kind of 5.5 where they peaked, and now we're plateaued at 4.25. So we do expect, again, the Fed to cut that down to 4 or maybe 3.75% as the upper band.
Yeah, it's interesting that if you go back in history, the Federal Reserve used to be like a black box. No one knew what they were doing. And in the Great Depression, they were criticized because they didn't do anything.
Yep.
And, you know, we had a depression for 10 years that my parents lived through, and it was terrible, right? The Great Depression is called it that for a reason. When it comes to the Fed today, the Fed is very active. People hear all the communication. I've seen the markets react based on a single sentence out of the commentary afterwards by the Fed chair. So it's changed a lot. Typically, the Fed raises too slow and cuts too slow. They're usually behind the 8 ball on this kind of stuff, and that's kind of what President Trump has been saying. We'll see if it plays out true today, but they're in a very interesting spot because they want to cut before we have a big problem in the economy, but not too soon to where we have inflation go back up. And that's a really tough, avenue to walk down to try to balance those two things out. I kind of agree with the consensus. I would bet that the Fed's going to cut a 1/4 point here at the next meeting. I do think there'll be more cuts to come. As I said, historically, what generally happens is they start cutting too slow, and then they have to cut a whole bunch very fast to try to rebound. Because remember, all the economic indicators, they're really lagging. So when we find out the jobs report, it's already passed. And for that reason, it could be a scenario where the economy gets into trouble before they start cutting. But yeah, 1/4 point's coming. I think it's going to be slow and steady more than fast, unless there's a big problem in the economy, which I know real estate has really suffered through the high interest rates. I think it's going to be some time before that there's relief. And I also don't think we're going to get 3% 30-year mortgages for a long time. But everything's relative, and people are short-term rearview mirror type the way they think about things, because right now if you say a 6 or 7% mortgage sounds ridiculous compared to 3, but if it comes down to 5.5, that's going to sound like a bargain compared to 6.5 or 7.
As the Fed cuts interest rates, instead of getting that 4.25 on your cash, maybe you're getting 3.75, maybe 3.5 as they continue to cut throughout the year. Good news is that if you've got a mortgage at 7%, I think mortgage rates are down about 6.25, 6.4% right now. And a lot of those mortgages are priced based off of the 10-year. So the 10-year Treasury rate is right now at 4%. So it's at 4.8% at the start of the year. It's at 4% today. And the goal being that, hey, as the Fed cuts interest rates, the question will be is, yes, we know the short-term interest rates, which is what the Fed can control, will come down. Will the 10-year also continue to come down? But it has from 4.8
That's a great
to 4.
point, because a lot of people think when the Fed cuts rates, mortgage rates go down. Yep. And they're not exactly tied together, although they influence each other, but they're not tied together.
Yep, and that actually bleeds into the next chart that we have here, which is the U.S. Treasury yield curve. And what this really shows is on the y-axis or the vertical axis, it shows the yield or the percentage return you're going to get if you hold the these treasury bonds, and then the x-axis or the horizontal, it's the different years. So you can see it's like a smiley face. The red line is the current yield, and it's a smiley face. And what that means is that from the blue line to the red line, yields have come down substantially in the middle of the curve, really the lower end in the middle of the curve. So it's been interesting to see the change of this yield curve. Now, the Fed, what they control is really the very front end of that yield curve. The overnight rates is really what they're changing. So as they decrease interest rates, they'll take that red line down, is the way to think about this. So one question that I would tee up for you, Jim, and this is a question, is that, okay, well, if the Fed decreases interest rates, because of all the things we've talked about, it decreases the cost of borrowing, it generally can increase the value of some of the assets, such as real estate, because it influences cap rates, stocks, because it influences the discount rate. Is there a lot more spending, investing, borrowing, which then could hypothetically increase inflation? And that's the trade-off that potentially is being made here. So curious to hear your thoughts, and specifically as part of this too, is if you're in the government seat, how does this impact, the budget?
Yeah. Well, that's a lot. One thing is, as I said, they're probably changing these rates slowly and gradually over time, because if they change them too fast, then you're right, it overheats the economy and there's too much borrowing. And then they create these asset bubbles that, we're always concerned about. As far as the federal budget and deficit, interest rates can have a huge impact, because now we have debt service and we have interest that we have to pay for all this debt that we have, and higher interest rates make it problematic for our debt in our country.
The good news is that if interest rates come down, the debt is constantly having to be refinanced. Ideally, that the 30-year rate, though, may stay higher for longer, because really the rates will stay higher if other people demand a higher interest rate to hold the United States government's debt. And so that's the fear, is that with our debt being so high, other people say, wow, there's actually some risk here with the United States government. Therefore, I need to get compensated for this risk, and I get compensated through getting a higher interest rate. So that's the fear, is that if there's more inflation, if there's more growth, does that then just lead to more debt? More debt means higher interest rates, and then we get in this perpetual loop. So one thing that is interesting, we got $36 trillion of debt, and as we're talking about the interest cost on the debt real quick, right now it's 3.1%, meaning that our net interest expense as a percentage of GDP is 3.1%. So essentially 3% of all of the government, the gross domestic national product there, is going out the door to interest expense. That's projected to balloon to 5.4% over the next 30 years. And as we have a chart here that we can throw up, this is from the CBO's most recent projections, and you can see the historical percentage of GDP going out the door in debt as interest payments specifically, and then you can see the projection going here, and really you can see the pink, which is the net interest outlays, really blowing up. And that's because, yes, our debt is ballooning, but also the interest rates are way higher than they've been in the past. Yeah. So that's why these interest rates are huge, and not just as an entrepreneur, but just as a country and a government. And when you have this amount of debt, just like if you have a massive mortgage and you have to pay 7% instead of 3%, your payment looks a lot different, and the government's starting to feel that. Yeah,
good point. And, just for the listeners, if you don't know the difference between deficit and debt, deficit is year to year. Like in a single year, do you have a surplus? That means you have more revenue coming in than you have expenses. Or do you have a deficit, which is you have more expenses than you have revenue? And we have, for many, many years, the U.S. government has had a deficit. And then they accumulate debt from that deficit every year. And that's the $36 trillion that you're referring to.